Okay, and again, thanks everybody for joining us. We'll go ahead and get started our webinar today. My name is Alex Oliver, and I'm a financial advisor with a company called First National Corporation. And as part of Schwartz & Schwartz Accountants Boot Camp series, we run a series of webinars here to go over an array of personal finance topics. So again, thanks for joining us. We hope to give you some useful information today. This is one of my favorite presentations regarding student loans and all the options that come along with those. Unfortunately, I meet a lot of people years after the fact before they were able to make some of the maybe correct decisions. So hopefully I'm catching you at a good time, or at the very least, you can pass this information along to somebody who could use it and make sure you get on the right path. So we're going to talk about a lot of different options as you get into your student loans to make sure this doesn't end up being a major burden on you later in your working life. Just to talk a little bit about First National Corporation, my company. We're located down in Rockland, Massachusetts on the South Shore, where we are what's called a registered investment advisor. So we're a completely independent company, and we serve as a fiduciary for both our wealth management clients and our 401k plans that we work with, generally around 450 families and around 50 retirement plans across the greater Boston area. Before I get started with our presentation, I always want to make sure I give this disclosure and make an emphasis on it, that any topics that I discuss today should not be taken as advice. There's certainly, again, especially in this realm of student loans, a lot of varying decisions to make based on your personal situation, and also your spouse's personal situation may also come into play, whether you're starting a business or whether you're working for a company. There's just so many topics that have to be considered regarding how to handle student loans. So again, please don't take anything I say today as advice. Make sure you consult some sort of advisor or professional before making any decisions here. Okay, so just to lay out our presentation, again, my core job here is to be a financial planner for my clients. And when I work with late 20s, early 30s kinds of people, making sure we get a comprehensive financial plan in place is the first order of business. So we're going to be talking about that today, because once we get the financial plan in place, that will allow us to then go down and make decisions on the student loans based on what we had come up with. So from there, we'll start talking about PSLF, which is public student loan forgiveness, RePAYE, which is revised pay as you earn, and then topics like married filing separately on your tax return and whether that's relevant for some of these income-based repayment programs. Again, a lot to talk about there. Eventually, you may get to the point where you need to think about refinancing your student loans. And in the environment here in 2019, we have incredibly low interest rates, both on mortgages and on student loans. So this is becoming more and more of an area where banks are actually specializing in student loan refinancing, and that really wasn't the case 5 or 10 years ago. So that's, again, something that we want to make sure we discuss. And then I'm going to also introduce a case study of what I think is maybe a typical client that came with a lot of student loans and really needed to get a full financial plan in place. And I think when we go through that, you'll see how many of the moving parts really affected the decisions that we made in that particular plan. Okay, so why is this such a big topic? Why are you in attendance today? Well, because a lot of people are coming out of school with student loans, and in some cases, especially if you're in the medical profession, pretty massive amounts. This talks about just going into dentists specifically, coming out with around $261,000 of student loans. Again, a lot of medical professionals are that way. I believe just a general across the board, somebody coming out of undergraduate school is coming out with about $30,000 of student loans. And when you just think about a married couple, each of them potentially coming out with loans, you may be upwards of $50,000 to $100,000 or much more. And again, if you're both medical professionals. So when you think about the interest accruing on that, if you've got close to $1 million in debt and you're getting $70,000 of interest per year, that's not necessarily deductible. That's going to be a major issue on your financial plan. And one thing I also like to, again, bring up, because this presentation usually does not get viewed by a 22 or 23-year-old. Usually the people attending this presentation are already in their late 20s or early 30s. Unfortunately, some of them have already gone into deferment or forbearance, where their interest is actually accruing and making these balances quite massive. So a lot of decisions to make and a lot of options that I want to make sure I'm making you aware of, so that way you don't end up in a tough situation. Obviously, a lot of life decisions come into play here. This is just going over some statistics about how some of us have to delay marriage, have to delay buying a house, have to delay having kids. And one thing that I try to do when I start working with a client or a set of clients is to really say, we don't necessarily have to delay those decisions if we can get the right financial plan in place. So hopefully we can get something that's not so out in the stars, hard to really fathom how I'm going to handle this problem. And again, some of the points today will make sure that it's just part of the financial plan. It's just another area that we need to take care of. So first thing I like to do when I'm working with a new set of clients is to assess cash flow, because frankly, if we are going paycheck to paycheck with a couple, it's going to be very hard to have a lot of options. It's going to be hard to look at some of these different repayment programs or to refinance. So, the first bullet point that I have here is just saying to live like a resident for 2 to 5 years out. Because if you're making, say, a combined $100,000, but spending most of that, a bank is going to look at you as a fairly risky profile if, again, you're going down the refinancing route. If you don't have an emergency fund, if you don't have any amount of money set up in a checking or savings account or some sort of investment account that's not retirement, that bank won't be able to really give you a refinancing option, because if you were to lose your job, they wouldn't have any assets that they could rely on you using to repay back their loan. So getting cash flow is really step one. Getting cash flow assessed is step one in this entire student loan evaluation. So living like a resident, keeping your expenses very low as we start to make these decisions, building out that emergency fund, which we say typically is 3 to 6 months worth of regular expenses, just sitting in a checking account, ready in case you lose your job, you have a car breakdown, you have a home repair, or a medical emergency, something along those lines. We also talk about retirement accounts in some of our student loan evaluations because, as you may or may not know, retirement accounts are one of your easiest ways to lower your overall tax burden. That's for anybody with student loans or without student loans. Everybody knows that if you put money into a retirement account pre-tax, you are avoiding paying income taxes at today's rates, and you'll withdraw them during retirement at a much lower rate. So again, for the general population, that's a great reason to save for retirement accounts, but I bring it up now during the student loan conversation because as we start to consider income-based repayment programs, when you're putting $10,000 away into a retirement account, you're also lowering your income by $10,000 and therefore potentially lowering your payments on your income-based repayment programs for your student loans. So really great bang for your buck there with a retirement plan if, again, you're also going to be going the route of income-based repayment. And again, we're going to continue to talk about that. Finally, I do want to also make sure I bring up the topics of life insurance and disability insurance here because we won't really talk about them too much more. I'll talk about it in my case study, but we want to make sure we have a safety net in place in case we do decide eventually to go down the refinancing route. So if I am married and I have a lot of student loans and we decide to refinance those loans and we add my wife as a co-signer, but then I get hit by a bus, that my wife will be on the hook for those student loans. And we want to make sure we have, again, a life insurance in place, just a term life insurance policy that can take care of a loan balance like that. So again, just something to think about. Again, and before we even get into any of the student loan options that we're going to discuss today, assessing cash flow to be able to take care of these 4 items is going to be a crucial part of the entire financial plan. Okay, so let's talk about income-driven repayment because, again, I see in working with client after client a lot of confusion around the different options that are available, and this is, in part the federal government's fault. In part, it's also if you have a student loan with Fed Loan and you call their customer service department, just keep in mind that they're not exactly hired to be a fiduciary on your behalf. They're not really hired to give you advice. They're kind of hired as, a customer service agent. Take your issue, help the best you can, but then move on to the next phone call. And that can really lead to some bad decisions being made. So I want to bring up a few of the income-driven repayment programs here because pay as you earn, PAYE, and then income-based repayment, IBR. These, if you've had student loans for 5 to 10 years, you might be familiar with them, and you might even be on one of these programs. They may be applicable to you, but frankly, they're not applicable in most cases. I've seen some examples where PAYE, pay as you earn, will actually give you the lowest payment possible. Again, that can be applicable for some people. But in 2015, a program called Revised Pay As You Earn, RePAYE, was also introduced. We're going to talk about that in length here in a second because that's become the dominant form of income-driven repayment programs for a few reasons. First of all, RePAYE caps your payments to about 10% of your discretionary income on all government loans. Let's keep in mind that we're not talking about private loans here. These are direct loans from the federal government. So, if I just really made a rough example here, if me and my spouse are making $100,000, our loans should be capped to at most $10,000 per year. Now, it's going to be much less than that because RePAYE actually also takes into account the poverty line, and that also will depend on whether you live in Boston or northern Vermont. Obviously, costs are a little bit higher in the city of Boston, so your payments might be a little bit lower than if you're in a rural area. But essentially, RePAYE is allowing you to cap your payments. If you stayed on the RePAYE program, you would have any undergraduate loans forgiven after 20 years. And if you were in graduate school, those would be forgiven after 25 years. But just keep in mind that that amount is a taxable amount to you at that time, and it won't be worth it for people who are making high incomes. So 2 doctors, they're not going to ever get to that point, and I'm going to show you a graph down the line here, which will really hit that point home. So again, RePAYE, really key for your early years. And again, this is where I just see a lot of mistakes being made where I think the default option is to go into forbearance or deferment, which can be a really big issue. So let's make sure we explain what RePAYE is. Again, you'll have your monthly payments capped, which is great. But the real kicker here to RePAYE is that the Department of Education, for the first 3 years that you're in the Revised Pay As You Earn program, they're actually going to subsidize any accumulated interest for you, up to about 50%. So I've given an example here where let's say you have a lot of loans, but your income is very low. You might have a payment as low as $200, okay? And again, it doesn't matter what your student loan balance is, it matters what your income is. So you've got this low payment of about $200. Let's just say that that loan, because the payment is so low, has accumulated $1,000 of interest in that month. What the RePAYE program is going to do is subsidize half of that balance. So about $400 of the remaining interest is added to the loan balance, and $400 is completely waived. So said another way, if your interest rate on that loan is 8%, for those first 3 years, your interest rate on that loan is only going to end up being about 4%. So again, if you're really young, if you're in a low income bracket, those first 3 years, instead of going into forbearance where your interest is going to accumulate, I would much rather you go into the RePAYE program to start some of those payments, get some of that interest waived. We're going to talk about public student loan forgiveness in a second, because if that's relevant, it's even more crucial that you get into Revised Pay As You Earn, okay? So I think, again, this is an issue where not many people are educated about the interest being subsidized and the payments being capped. So if you're in a position here where you might be on pay as you earn right now or income-based repayment, consider calling Fed Loan and asking about the RePAYE program instead. Okay. I've given a little link here, studentloanhero.com. This is a great website for all things student loans, and there's a great issue here about loan forgiveness for dentists that maybe are not owning their own practice. So that's just a little bit of a resource for you there. Public student loan forgiveness is a huge topic, especially in the political spectrum these days. Is it going to stick around? Is it going to be eliminated? Last year was the first year that people could start to become eligible for this program. And let's just make sure we set the boundaries here so we can all be on the same page with what we're talking about. Public student loan forgiveness is essentially for somebody who's working for a nonprofit, and if they work there for about 10 years, they can get their student loans forgiven tax-free, okay? So again, last year would have been the first year that somebody could have gotten their loans forgiven, and there was a lot of media around how few people got public student loan forgiveness, how few people actually got their loans forgiven. I think the number was something around 20 or 30 people actually got their loans forgiven, but around 1,000 people applied to get their student loans forgiven. And when you really dive into that study, it just shows that most people didn't really understand how public student forgiveness worked, either that they had to work at a nonprofit for 10 years or that they had to make 120 consecutive payments toward their student loans, which I think is a big thing. So let's make sure we set the basis here. If you are going for public student loan forgiveness, you want to be certifying your employment every single year. So you go to Fed Loan and you certify that, yes, this is a nonprofit. You may have somebody from HR sign off on that, and now you've got a year of certification. I've met a lot of clients who think that they're 6 years in, but they haven't certified any of their years of nonprofit work, which is a huge issue. And what I like to tell people is that if you are trying to go for this and you're worried about the federal government eliminating public student loan forgiveness, I really can't see a situation where you would run into that as long as you have certified all of your years of employment. Now, if you've been 6 years in a nonprofit and never certified, I could see that being an issue if it ever came up. So make sure that every year you are certifying your years of nonprofit work. Now, again, this is where RePAYE comes in, because in order to qualify for public student loan forgiveness, you have to be making payments. You can't be in deferment. You can't be in forbearance. You have to have 10 years times 12 months, which is 120 payments towards your loans. So that's why we want to make sure we get onto the revised pay-as-you-earn program and cap our monthly payments, especially if our income is low, while also, again, making payments so we're eligible for public student loan forgiveness. That, again, is helping us to subsidize our interest. That way, if 4 years in, we decide we no longer want to work in the nonprofit sector, maybe we want to go to a private hospital or what have you, you're okay in that situation with revised pay-as-you-earn because now you've had some interest subsidized. I've noted here that pay-as-you-earn may also be an option for you if you know that the next 10 years of your life are going to be in the nonprofit sector. So again, this is where don't take my advice on this because it really does depend. If eventually that you decide that you don't want to go to public student loan forgiveness, obviously at that point, refinancing your loans to a low interest rate is going to be a crucial part of your whole financial plan. And again, we're going to continue to talk about that here in a few moments. Okay. So I've put up here a few tax tables just to show you where your incomes, may lie, because we have to make sure that if you are a married couple or if you're getting married in the near future, your spouse's income is also going to affect this entire decision about which repayment program you want to be on, and then maybe even whether you want to be filing your tax return on a joint basis or on a separate basis. Okay, so again, the first tax tables were on married filing joint, and these second tax tables are married filing separate. And I'm going to give you just a quick example here where this can, really affect your decision, because when you're filing separate, the whole idea here is that if I make a small amount of money and my spouse makes a lot of money, I may want to file my taxes separately, because if I'm going under revised pay-as-you-earn, my small income will also mean small student loan payments. Okay, so if there's a huge disparity in income, that could be a reason to do that. However, there are many other factors here to consider, because I've just given an example of two different kinds of couples here, where one makes $400,000 and the spouse makes a smaller amount, $77,000. If they actually file separately, they're going to be paying much more in taxes based on those tax tables, so around $12,000 more. So just filing separately is not a decision in its own just to get my payments lower. If I'm also going to be facing much more of a tax burden, I may not want to do that. So it's just, again, a decision that you have to analyze on yourself or with an advisor. If your incomes are relatively similar, maybe, again, in this case, I've given a couple that makes about the same amount of money, their tax burden would be the same, whether they file jointly or separately. So again, just depending on where your incomes lie and the tax tables, you want to work with that with your financial advisor or with your tax advisor. Okay. I've included this chart here. I follow a blog, and I would encourage you guys to do as well, from the White Coat Investor. Because if you're in the medical profession, I mean, if you want to do all these things yourself, and really take finance on your own. This is a great blog to get a lot of interesting information from. And what he's done here is really broken down sort of the break-even points as to whether you should consider to go for public student loan forgiveness or not. And just to explain this chart a little bit, the top axis here is just showing what your student loan balances might be. Keep in mind these are direct student loans, so direct federal government loans, not private loans. The varying balances compared to adjusted gross income on the left side here. This is, again, adjusted gross income. So if you and your spouse are married, and you have a joint income, this would be you and your spouse combined, not you and you guys on your own. And so if we just look at some of the extremes here, what this is showing you is that, let's just say you and your spouse or you on your own are making $25,000 per year. And on the other axis, you have $425,000 of student loans. What this chart is showing you is what kind of a balance you would have 10 years from now if you were on those loans and were under revised pay-as-you-earn as a payment, okay? So again, low income, so your payments are going to be very low, and therefore your student loan balances are going to continue to accumulate. You started out with $425,000. 10 years from now, you've got a balance of $574,000. But in this case, this person gets $574,000 forgiven tax-free, which is a great situation for them. These red colors are basically where it's a no-brainer that if you're in this income bracket and this student loan balance, you want to really seriously consider going down the public student loan forgiveness route, okay? As we go along here, let's just say we've got a couple with $100,000 of income and they've got a student loan balance of $75,000. Well, now we've got this orange color where 10 years from now, if you stayed right there, you're still going to have a balance, but it's a little bit trickier of a decision because maybe you won't go nonprofit for the next 10 years, or maybe your incomes will rise. And then finally, if we just look at some of these examples, if we've got a couple that's making $400,000 and they only have $100,000 in student loans, 10 years from now, because your incomes are so high, revised pay-as-you-earn is going to have you make enough payments to pay that balance off within the next 10 years. So a couple like this would never go down the student loan forgiveness program from a financial standpoint, okay? But these yellow, areas, these crossover points, again, if you're making $200,000, but you've got a balance of around $200,000, it's a little bit of a decision. You're in that orange area where it might actually make sense to enroll in revised pay-as-you-earn and try to stick with public student loan forgiveness over time, okay? So if you want more information on that, white coat investor, PSLF, attending physician, I'm going to tell you right now that these numbers are not perfect because, as I mentioned earlier, the revised pay-as-you-earn is based on poverty guidelines based on certain cities and certain states. So I think these numbers are based on his home state of Utah, if you were to live there, and what they would come out to. But I think this is a pretty good guide if you're young and still trying to make some employment decisions based around public student loan forgiveness, okay? However, for a lot of you, you might have heard a lot of this presentation and thought, well, I think I actually need to just refinance these loans, and what do I need to do to get ready for that? So I really want to spend a little bit of time talking about that, because I still see a lot of people that walk into my office with student loans at 6, 7, or 8%. They're not going for public student loan forgiveness, and they just have not looked into student loan refinancing yet. There are going to be a few factors that you want to consider here. Certainly the bank is going to look at your debt to income ratio. So if you have $500,000 in student loans and only $100,000 in income, it's going to be pretty tough for a bank to look at that and say, we're going to let you refinance your loans. So you may have to wait a few years to be able to be a good loan profile to be able to do that. But there are some things that you should keep in mind as you're getting ready for that process. I've got a little bit of a box over here that just shows how to increase your credit score. I think we all know that by paying our loans on time, paying our credit cards on time, we're going to increase our score and therefore be looked at as a better candidate for refinancing. The amount that we owe is also a very important part. Length of history, you want to make sure you're getting your credit cards early on and then paying them off. One thing I do like to note here that I don't think many people really think about is that the amount owed, which is 30% of your overall FICO score, is in consideration on what amount of available credit has been made available to you. So if you've gone out and you've got credit cards that have given you a credit limit in total of $20,000, and on a monthly basis you put $5,000 on those credit cards, you're using 25% of your available credit limit. Okay, so $20,000 of limits, $5,000 of expenses, 25%. That's actually a pretty high amount, and you would be looked at as a roughly risky candidate for refinancing. So what I encourage people to do, especially if they're a year or two from wanting to refinance their loans, is to call their credit card companies and ask for an increase in their credit limits. If you've got the income to support it, you may find that that Visa or MasterCard might just go ahead and raise your credit limit from $10,000 to $20,000, from $20,000 to $30,000. This is something that I did every 6 months, after I got out of college. Is just kept calling the credit card companies until I got upwards of $100,000 of limits. Because now, if I'm putting the same $5,000 of expenses on my credit card every month, but I've now got $100,000 in credit limit, I'm only using 5% of my available limit. So I look like a lot more like a stable candidate than that previous candidate who only had $20,000 in limits. Okay, so ask for credit limit increases if you're a little ways away from refinancing. I will also say that, again, we talked about life insurance earlier. It would be a good thing to get in place if you think you want your spouse to co-sign or somebody else to co-sign as part of your loan. So again, if your income is really low and again, you're not going for public student loan forgiveness, you may have somebody else co-sign, but take out a term life insurance, which might cost you $200 or $300 a year, and name them as the beneficiary in case you were to get hit by a bus and they're left with this loan balance. Okay, so there are some things that we can do here to get your profile looking better before going down the refinancing route. And I just want to talk a little bit about an example from a client of mine. This was, I won't read the whole thing, but I'll just give you a general summary here, because this was a dentist and a physician. The dentist had about $500,000 in student loans. The physician was about $100,000 in student loans. And they have a lot of things going on because they're in their early 30s. They want to start a family. They want to buy a house. So trying to figure out how they're going to put money to all these different things was a huge issue. And as we talked about in the beginning part of this presentation, putting a whole financial plan in place first was crucial. So making sure that we got disability insurance in place, which luckily they had through their employers, even though Jeremy had 180 days until he would be eligible for his disability insurance, at least he had something, but it really did emphasize the need for an emergency fund. So getting some cash on hand, about 6 months worth of expenses, that was priority number one before we did anything, okay? Getting some cash on hand. We then looked at life insurance because, again, we knew that we were going to be refinancing these loans at some point, and we would need both incomes to be able to qualify for that refinance. So we had Jeremy take out a $1.5 million 30-year term policy, which gets them through retirement. It gets their children up to college, and again, helps Kathy, in this case, have an amount of money in case Jeremy gets hit by a bus and can't pay back those loans. Okay, so that's the base of the plan first. We then look to go and tackle the student loans directly because they're at an interest rate of 7.9%, but they only had a combined income of $150,000 at this time. And as we got into the weeds here, we saw that, again, we needed Kathy's income to refinance Jeremy's loans. Jeremy's credit rating was great, but Kathy's wasn't. And it was just interesting in this case because a very quick analysis found out that they had a mattress loan. So they went and bought a mattress for $3,000 and it was 0% interest for 36 months, which, is a no-brainer. I think anybody would take that deal. But as we go back to that earlier example, when we talk about available credit, they had basically taken out a $3,000 loan and had a balance of $3,000. So they were using 100% of their available credit limit, which brought her score down. They immediately put a $2,500 payment on that. So now they only had a $500 balance on this mattress loan. They went from a credit score of 680 to 732. That's Kathy in this case. And that made us, again, available candidate now to be able to refinance the loans. So we looked at a few different companies. We looked at, I think we looked at First Republic, but we ended up settling with Common Bond. We went on RePAYE for the federal loans, so we capped payments there. We got their interest rate down to 5.6%. I wrote this summary in 2017, I think, because I can tell you we just did another refinance in the last month or two, where now they're down to about a 4.1% interest rate, and that's because their incomes have risen, and now they qualify for a better rate there. So there's a few things there that we wanted to, again, make sure we kept in mind. Again, I told you that they wanted to buy a house. So now we've figured out cash flow from a student loan perspective, and now they ended up, saving about $1,200 per month toward the down payment of their home, which they were able to purchase a home last year. So, again, we're talking about student loans here today, but I just wanted to make sure I brought this all into perspective, because this really is a behemoth to every part of your financial plan, and gets addressed in a variety of different ways. Because I can also tell you that Jeremy, in this case, he wants to buy a practice. He wants to buy a dental practice, and he's going to need some available cash to sustain his living, to be able to qualify for a new loan. I mean, this is a couple that's just going to have student loans, mortgage debt, practice debt, maybe even building debt for quite some time. And we really needed to make sure we ironed out a lot of these details to make sure we put them on the right path. Okay, so it's not necessarily just a side-load decision. We want to make sure we put the whole financial plan in place. Okay, so we're going to start to close here. If you are going to be going down the route of refinancing, if you've heard everything I've said today and just thought that's what I need to do with most of my loans, I want to make sure I give you a few options here. First Republic, if you are a very high credit-worthy kind of a person, you've got a big loan balance, you have a high credit score of over 750, you've got at least 2 years of work experience within your industry, this is the place to go, because frankly, they're going to have the lowest rates that I've seen consistently. The problem, again, is that a lot of people don't necessarily qualify in all of these parameters. And so I have had a lot of clients get declined from First Republic Bank. So I call them first, but maybe keep expectations low. If that does not end up being an option, I think where I've seen most of my clients refinance is either Common Bond or SoFi. SoFi is just popular because they do a lot of marketing, but they also do have some pretty competitive rates. I would certainly shop around though and make applications to at least a couple of these. Common Bond, Laurel Road. If you're a dentist, they're going to give you a 0.25% discount for going with them. And then Earnest and Linkey are also great options. I have some notes here that there are some referral codes that are out there where you can get $200 or $400 back just for going with one of these companies. If, again, that interests you at all, just send me an email, Alex@FNC Advisor. I'll show it at the end of this presentation, and I can point you in the right direction to get those referral codes to you. Okay. A final couple of notes here. I alluded to it with my dentist earlier. Will I need a loan to purchase a practice? If I'm going to be buying somebody else's practice, I may not want to refinance my student loans today to a 5 or 7 year time frame. I might actually want to extend that out to 10, 15, or 20 years, knowing again that I'm going to need cash flow in the short term to purchase that practice. So, again, I really encourage thinking about the next 5 or 10 years as opposed to the next 3 or 6 months when you're refinancing these loans. Otherwise, in order to get those teaser rates, in order to get that 1.95% interest rate from First Republic Bank, you're typically looking at a 5-year student loan, okay? Which again, may be okay if you don't have any needs for cash in the next 5 or 10 years, but those payments are going to be pretty high. And if you're going to buy a practice in the next 5 years, it's going to be a big burden for you being able to get a loan for that. Same thing if you need to get a mortgage to purchase a home. And, again, same thing here with paying off loans, building liquidity, or lowering your tax bracket. All is determined about how your incomes are and what your family situation is. So I really would encourage sitting down with somebody to get a full evaluation on what that best path would be for you. As a summary to our presentation here, I think a real blanket statement, one of the only blanket statements that I can somewhat make in this presentation, is that if you're in training, you want to really seriously consider enrolling in Revised Pay As You Earn, because again, your income is very low at this point in time. Your interest is going to be subsidized. and we'll get you 3 years down the road to, again, maybe public student loan forgiveness or a point where your income is higher and you're going to refinance. If you're in training, you want to consider refinancing any private loans you have. Again, we can't do anything about the private loans, so looking into refinancing every year, you may want to consider doing. Again, the last couple of years, interest rates have come down quite a bit. Those companies that I mentioned, very specialized in student loans, is probably a better option for you as opposed to paying 6.8% or 7.9%. If you're post-training and you're going for PSLF, make sure you certify that employment every year. If you're post-training and not going for PSLF, you want to refinance your loans and then have some sort of financial plan that's going to allow you to pay those off relatively quickly. And then again, live like a resident until student loans are gone. Everything I've said today is really irrelevant if you're spending most of your income. We just don't have a lot of options with that. So try to keep your expenses super low, eat your ramen noodles, and allow yourself to get to your 30s, mid-30s with a stable financial plan, okay? So just in wrapping up, I want to make sure I inform you of our website here. You know, I talked about our clients earlier, and a lot of my clients, you know, you should know we work with on a flat fee basis if they don't have any assets to manage. So I've got a lot of people who are in their 20s or 30s, again, that don't necessarily have savings or retirement accounts, but we can work with them on a flat annual fee or monthly fee to give them a whole analysis of these kinds of topics. So don't be afraid to reach out if some of this is a little confusing and you need a little guidance on what exactly your financial plan should be. We've got a lot of great resources in here to go well beyond student loans, a lot of different tabs you should think about visiting. We've got a whole tab here in case you are a dentist that you should consider visiting as well. Even if you're not a dentist, consider visiting that tab, because what I've done is I've put a whole ebook together, which is completely free, and it comes in a Kindle format. This lays out some of the chapters here, but you can see going through the foundation, disability insurance, term life, estate planning. We've got a chapter on student loans here, Roth IRAs, and then we get into some of these accelerated areas where we might be buying a practice. We want to really take a look at our investments. Essentially, your entire financial plan might be able to be found within this ebook, and I think is a great 80-page book or so to give you a crash course in personal finance. So if that interests you at all, just go to fncadvisor.com/dentist. I would say that if you're not a dentist, around 80% of this content is still going to be relevant to you, because again, you're still going to need to deal with these issues right here. If you're going to be an employee, these won't be relevant, but if you're a business owner, these will still be relevant, just in some different ways. So again, it's free. Feel free to visit the website and request a copy of that. Otherwise, I'll leave my information here. If you need some of those referral codes for refinancing your loans, or just have general questions about student loans, don't be afraid to reach out, alex@fncadvisor.com, and I'm happy to schedule a quick 15 or 20-minute meeting to clarify any concepts that we've talked about today. So thank you everybody for joining, and I look forward to seeing you at the next Financial Bootcamp presentation.